Hello everyone, welcome to this video. And in this video, we'll be interviewing Avishek Bannerjee. He's the founder of Afinue. I'll introduce you to Avishek Bannerjee. He is the founder of Afinue, which was earlier called Upcide. He has more than 20 years of experience in finance and consulting. And he has been working with the likes of ENY, KPMG, and PwC in his prior stint. He has got a deep experience in asset-based financing, which includes real estate, hospitality, and infrastructure sector. I think which sets him apart from a lot of other founders of platforms is that he has real-world experience in working in very complicated and complex deals, which can be seen in the deals available on the platform. I personally use Afinue. I've invested in a couple of deals. I really like the kind of deals they have, the due diligence, the information they provide, and the performance of the deals has been really good. So thank you, Avishek, for being here with us. I know you're a very busy person, but taking out time for us because our investors, they have a lot of questions for you because now they started investing in the platform and they want to know a lot of things from you. So over to you.
Thanks, Rowan, and thanks for the introduction. Thanks for introducing Afinue and my background. Good to be here. Good to answer questions. I'm happy to take any questions that you may have. As we always say, we are open about what we do. We don't have any conflicts. We don't have any kind of ulterior motives to invest in anything. And we always say that we are focused on the wealth of our investors rather than lending to our borrowing partners or our ecosystem partners. So let's open it up and shoot the questions that you have.
So I think the first question would be, what is the reason for changing the name from Upcide to Afinue?
All right. So when we started Upcide, our intent was to say that we are going to only look for investment opportunities which provide significant upside to our members and our community at large. As we grew along the last 2 years, and we've just completed 2 years this August, we actually have expanded ourselves to not just look at only the monetary upside, but also economic, environmental upsides to not just our investors, but to our ecosystem partners and the community at large. We are now doing things that are beyond pure economic upside, and therefore we thought it's important that our name also reflects that. So Afinue actually stands for your avenue to explore alternatives across assets, finance, investments. And this is for those who have affinity towards alternative investments, investment in people, investment in businesses that are doing different things, and obviously technology, which is impacting lives at a grassroots level and at a here and now level, and not looking at rocket science at this point of time. Our identity therefore the new identity allows us to present ourselves as a truly diverse platform, innovating in different areas of the economy, different areas of businesses, different businesses altogether, and continuously focusing on the alternative side of it with asset-backed, asset-based businesses. So Afinue probably seems much closer than Upcide because Upcide was only giving a sense of economic upside, while Afinue is more towards the avenues of financial independence, alternate asset finance, alternate asset investment. So that's the reason we moved away from Upcide to Afinue.
Great. So you mentioned that this platform is an avenue for people to invest in alternative investments. And I've been using this platform for more than a year, and I can see the different kind of deals listed on the platform. So I personally invested in a couple of asset leasing deals. So, but what are the other kind of deals on the platform? What kind of products does the platform offer apart from asset leasing? And even in asset leasing, I understand there would be different kind of deals. So could you just throw some light on the kind of deals available on the platform?
Absolutely. So yeah, our core has been, when we started off, the core was to focus on asset leasing because asset heavy startups needed finance to grow, and obviously structured institutional finance was not available without dilution of equity. So we came up with asset leasing in 3 forms. One was a pure asset leasing, which is where your floor is fixed or the ceiling is fixed, and you get a structured asset leasing with the B2B model. Then we introduced the asset leasing with equity options, where our members actually invested in other businesses, not just by leasing them assets, but also acquiring minority stakes. So we call them as blended structures, and this enabled the organization, the ecosystem partners, to grow with our assets, as well as actually our members to grow with the business if those asset-led businesses made revenue multiples. So that was the
So
blended.
this the blended deal, I think these kind of deals I can only see on your platform. So could you just explain how these deals work, where you get equity alongside
Right.
getting interest?
So what happens in these deals? I mean, they're very simple. It's like somebody wants, let's say, X hundred assets to deploy on their businesses, and these assets generate revenue for them. The business will obviously get a valuation multiple based on the revenue multiple or the EBITDA multiple. Now, these assets are generally leased through our leasing partners or our members through our structured finance route. When they lease these assets, obviously, the moment you get your asset base move from X to Y, that incremental addition that you're doing to your asset base is going to get incremental revenue. Now, this incremental revenue with a basic multiple of whatever is the relative multiple for that industry or that segment is going to add to your valuation gain. So our logic is very simple. If you're taking 100 units worth of assets from us, give us 10 or 20 units worth of equity in your business, either through structured pure equity or through CCDs or CCPS, CCDs and CCPS. And on that same asset, as you grow along, if you get revenue multiples and a new set of investors come, when you convert your equity or you get a valuation multiple for yourself as a business, pass that out to our investors as well, to the extent of their minority shareholding, and that conversion essentially gives a boost to the IRRs that our investors are making from a traditional Now, this is not a separate deal. It's part of the same structured deal. So it's in a way you can call it as a venture debt kind of a structure, but it's not really a venture debt, because venture debt generally is dilutive for the investor. There is a force within 12 months or 18 months version of their warrants or their CCDs. In our case, we give the right to the promoters, the founders, to not dilute, and they can either pay coupon rate, which is essentially structured with the lease, or they can convert, and that gives them the flexibility. Even though we are very minority, it still gives them the flexibility to actually exercise their rights better. So it's kind of a win-win for both our members as well as the founders and promoters of other startups who are asset heavy, to actually get asset finance without diluting upfront, and diluting at a later date when there is significant earnings being done from the assets that we have financed or otherwise. I hope that explains the structure.
Yeah, that was very detailed. Thank you for that. I think lot of the people invest in alternative assets because, one, they want to enhance the overall yield of their portfolio, and second, they want to diversify because a lot of these investors are already invested in equity and they understand there's a lot of market volatility associated with equity. So the reason to choose alternatives is to, one, to get higher returns, and second, to reduce the overall portfolio volatility. So what returns can they expect from your platforms, and for the returns they're getting, what is the risk associated with these deals and how is it managed?
Sure. So I think I'll take the first part. See, I mean, what we have been able to deliver so far is in the range of 13% post-tax IRRs on our asset leasing and structured asset leasing products. In some cases, we have actually breached 15.5% post-tax IRRs as well. We believe we are providing probably the highest returns in terms of the peers that are there from a like-to-like asset risk to reward ratios. In our real estate portfolios, we are looking at roughly 11 to 12% IRRs because the yields are higher there, and the IRRs are dependent on terminal valuation gains, which is, again, as real estate is cyclical. So we don't know when the exits will happen and will the market have a buoyancy at that time or not. With reference to non-real estate assets, as I said, we have been delivering 13% and upside and upwards of 30% leasing. which has been the last 2 years that we have done. Our first deal was in October 2022. So roughly about 19 months, 20 months that we have delivered these kind of returns. Obviously, the risks are higher. These are not as, I wouldn't say the risks are higher, but the risk mitigations are more required in our kind of assets because these are not structured through any kind of controlled environment where you have access to other securities. Our securities are primarily three forms. One is the asset itself. The asset is owned by the structures that the SPVs that are created to make the investment. Secondary, we have escrows on the revenues that come on those assets. Tertiary is we have corporate guarantees or promoter guarantees or additional securities, economic securities that we take. Typically, we range our security in the range between 1.25 to 1.5x of the asset value that we are deploying. So that's the risk coverage that we get. But it will be wrong to say that the risks do not exist. The risk exists. The risk is if the business fails, risk is if the promoters fail or are unable to perform with the assets that we're providing. And finally, if the economy fails in terms of where this business is actually delivering value to the economy. So we have selected 4 segments of the economy to work with. Essentially, the intra warehousing and logistics side, a sunrise sector. All indicators indicate that this will be a pretty big growth area for the economy for the next 10, 15 years. Mobility, and especially electric mobility, where the transition from ICE vehicles to electric is happening, and it's happening extremely rapidly up to 10 years with fairly strong regulatory tailwind with reference to changes of vehicle norms, the Bharat standards coming in, and the standardization of electric charging protocols will lead to significant growth of electric mobility, both in cargo as well as in passenger area that we're focusing. Third is food. Food is going to be big, and we are not focusing so much on the agri side of food, but most post-agri, which is warehousing, sorting, packaging, D2C, and obviously vending, etc. Where we are looking at packaged food, ready-to-eat food, ready-to-drink area, and now we are venturing into restaurant. I'll take that up separately in the new areas that we're focusing. And finally, we are looking at real estate and bespoke structured products, trying to bring in new things that people have not seen, but essentially asset-heavy businesses. So when we're looking at these 4 or 5 segments, the industry risk or the economy risk is primarily baked in because everyone knows that at least for the next 1 decade, there's growth that's there. So then the 2 other risks is what primarily we need to focus on, which is the asset itself. Is the asset going to become redundant? Is the asset going to become unuseful very quickly? And second is obviously, are the promoters and the businesses strong enough and able to do that? So when we look at the businesses or the promoters, our focus is almost like a VC. We're banking the promoters. We're looking at their integrity, their background, their intent of doing this business. And when we look at the asset, we're looking at saying that is the asset going to have a lifespan of at least 5 years? It's going to generate economic value for whoever's using it for at least 5 years, minimum. And therefore, we take a risk of 2 years to maximum 3 years on that. There have been terms where we have got, for example, we have never done electric two-wheelers. I know my peers and a whole bunch of other people are funding electric two-wheelers left, right, and center. We still believe that the technology on that is not settled. It's going to evolve extremely rapidly. And therefore, we believe that the lifespan of those assets are not worth the risk at this point of time. So we have not touched them. However, we are still open to look at more sturdy versions of electric two-wheelers, which are not really passion vehicles, but actually the mules of the industry in terms of the mobility sector. We are happy to look at those. But fundamentally, the slow vehicles or the high-cost vehicles in the electric mobility space, two-wheelers basically, we have not touched them at all. Similarly, touch very unique industrial products. We don't touch any very long-term projects where you're doing assets which probably have a gestation or a payback period of more than 5 years. We'll not touch them. And finally, at a business level, beside the promoter and the background of the founders and the key team, we also look at the revenue model. How are you making money from the asset? We always look at unit matrix to start with. At a unit level, if you're not making enough to pay us back and keep something for yourself, and you are going to fund it through your equity, then there's a problem. So the unit matrix needs to make sense. So those are the parameters at which obviously each deal, there are various other details that we go into, but fundamentally these are the nuts and bolts that has to be there for us to actually move ahead with a deal and then bring it to our investors.
This is very interesting because a lot of people just think, when it's asset based leasing, so it should be safe. But you covered, I mean, there are multiple nuances to asset based leasing, the kind of sector it is in, the kind of asset it is, the future of the asset, the promoters. So I think this will help the investors, in choosing the right assets and the right platform. So I think
I think
yeah.
the biggest part is on that we don't go by saying that if the organization has a runway of 2 years or the organization has a funding from tier one investors, we don't believe in that, because until the asset makes money, the investors are not going to just let you burn their equity to fund the asset and the revenues. It won't be sustainable.
Yeah, I
We
mean,
want the asset to make money.
yeah, if you always believe that maybe the equity will last for that time, so you are always running the risk.
Right. So the asset needs to make money from day one. Maybe the enterprise is not making money, but at an asset level, the asset needs to make money, should be able to pay back its EMI, so to say, and therefore and operating expenses, and still leave something for the business on the platform, on the platter, to actually make money out of.
Great. So you talked about your general philosophy of selecting assets.
So obviously sourcing is a multifaceted area. It's not a single method of sourcing, but primarily segments in the economy that we want to focus on. We do our own research. We look at the market. We keep looking at it, of saying who are the new players or who are the existing players with whom we have not worked before, who is doing well, and we then try to do outreach. So in a way, it's like a VC set of analysts sitting and trying to do it, figuring out where to go and talk about.
So as I can see, I mean, your structure is quite robust compared to what I have personally seen in other platforms. So, but what are the other ways in which you are different from other platforms? Because these days there have been new platforms which have come up in the last couple of years, which offer leasing as an asset. So what makes you different from some of these platforms?
So I'm sure there are many, and we have seen a few. We do follow a few as well to understand any innovations or new technologies or new asset classes that they're backing. So it's good to be aware of the ecosystem. I don't know how different we wish to be, but fundamentally, I think as of today, we are giving one of the highest returns from a similar asset classes base. We don't believe in giving 11-12% pre-tax IRRs to our investors, because that's not wealth, that's lending. And that's essentially post-tax is 8.5%, which doesn't make sense for a wealth platform to do. Anyone can go and get it from anywhere in the market. So our opportunity is always structured at between 12 to 14-15% now, and in a way that our ecosystem partners who are actually funding that, which is essentially the people who need those assets, also don't feel the pinch. So we try to structure it in a way that is most tax efficient, it is most prudent in terms of law as well as returns, and fundamentally enabling both sides to have some bit of good outcome from the whole structure. So we don't go by whether you are funded, we don't go by whether you have A-class cap table participants. We purely go by, as I said, asset risk and the business risk. To that extent, we have been able to give high returns with working with good people. In some cases, obviously, as I said at the beginning, we have structured products, so you have equity exposure also. So some of these businesses, if and when they do well, which they are doing well in our monthly reports and our quarterly reports that we see, at a point when they liquidate that equity and get a new investor on the cap table, our investors will also stand to gain significantly. And finally, we're looking at opening up newer avenues, and that's why the brand name change, which are not available today, are not available in a democratized, institutionalized, and digital-first manner. So we are opening up, as I said, I'll tell you about, so we are opening up the restaurant business in our food segment, where our investors can actually be owners in a restaurant business. which is not available to any platform today. Every platform seems to be moving towards lending. They will do bonds and whatnot, but we are moving towards more business. So our approach is to invest in businesses and be part of the business and not just do lending through structures.
Right.
So we're opening up restaurants. We are opening up the hospitality sector, both in the real estate form as well as asset leasing and B2B investment structures. And hopefully we have a few more up the sleeve, which are quite new. So investments in Alcobev globally as well as domestically is something that we are looking at. Opening the collectibles market, specifically in the watches segment. You yourself had done a piece in past on watches and how they have performed.
Right.
And that's a fantastic play because of inflation hedging as well as replacement value gain. Because on an average, a basic Rolex takes 2,000 man hours.
Right.
And the inflation hedge of man hours in Switzerland is roughly about 12% annualized. So just to make the same Rolex next year is going to be 12% more expensive.
So that's a very interesting perspective. I mean, when we think of assets, we never thought of, how the man hours would be used in creating that asset. So it's another way of looking at an asset.
The value accreditation is not necessarily purely based on the buyer's value accreditation. The seller itself cannot reproduce that asset at the same price. It just cannot be done. Economies of scale in a manufacturing is a notion that we keep believing that you will keep getting cheaper thing, but it's not possible in some assets. So those assets will continually appreciate because the seller himself or herself will basically put the price up. Great. And therefore the replacement of a new asset is going to be, and the lifespan of that asset is, we are yet to see a Rolex that cannot be made to work out even after 70 years. It still can work.
Great.
If it's purely mechanical.
I'll have one final question. So this is a thing which a lot of investors have been asking. They're saying, I mean, platform has been doing really well. So what is the future pipeline, the immediate future pipeline look, for your platform, for Afinue? Because a lot of people would be interested in investing within the next couple of months. So what can we expect from your platform?
So I think fundamentally 3 things. We are continuing to do what we have done, which is asset leasing. So we are opening up new asset opportunities. We have just started a new deal right now on vending, ice cream vending, which is pretty unique. The second one is around digital out of home. So that's something that nobody has seen before. But if you are in the cities of Mumbai, Bangalore, Hyderabad, digital out of home is something huge, where all the traditional out of home is getting replaced, transitioned and transformed into digital. So those screens, the LED screens, etc., is a huge opportunity for leasing it. My rough estimate of just the Mumbai market itself is roughly about 2,500 CR is the cost of replacing existing holdings to digital holdings, and at a 50% conversion, which means the rest 50% will never get converted. And this does not add the new kind of digital out of home that can be included in the ecosystem of Urbanscape. So that's a massive market. That's what we are opening up. We are also opening up agriculture, but not agriculture as food production, but agriculture as sorting, packaging. So we're looking at cold storage chains, etc., as a new opportunity, because food wastage and currently the food price gain that has happened and in fact inflation, people have been seeing this for the last 20-25 years, but our food ecosystem has not been upgraded with new technologies. So we believe that cold storage, packaging is going to be significant to reduce wastage. And so we're looking at that. And finally, on restaurants, we are looking at least 2 new restaurants in the next 3 months, mostly in Mumbai region, where we are looking at the one which is a kind of a restaurant model, and the other will be more fine dine with a branded chef, established chef. Imagine you backing a Jamie Oliver 20 years ago, if that works out, right? So we are looking at those kind of innovations on investment, private investments in new businesses, and opening that up through a digital platform to our community.
Great. Thank you, Abhishek. It was a very insightful session. I think a lot of people will find it helpful. Not just the information was not just about Afinue, but the overall sector, about asset leasing. I think a lot of people, when they go through this video, they'll understand how to understand asset-based leasing, how to understand what's a good asset, what's a bad asset. So because a lot of people till now, they were clueless about asset leasing. They just thought, you just invest two deals are same, but this gives a fresh look into how you have to understand asset leasing. Thank you for your time, Abhishek. And I guess people would have more questions. Probably I'll pass those questions to your team and they can answer. And I
Sure.
wish you all the best for your platform. I'll definitely invest in the upcoming deals,
Thank
and
you.
I think a lot of other investors will also do that.
Thank you. Thank you, Ron. Have a good day, and thank you so much for your time. Pleasure
Thank you.
talking to you.
Have a
Bye-bye.
great day. Bye bye.